Okay,
Okay,
good. Now we can switch off our cameras.
perfect. So
Okay.
let's come in at around 58.
Okay. Sounds
Great.
good.
Thanks so much.
All right. Mm-hmm.
See you. Hello, everyone. Good morning / afternoon, and welcome to this webinar on private finance innovation for nature-based solutions, restoration and conservation. I thought we would give it a couple of minutes to allow some more people to join, but I think we have a good quorum, so I think we can start. My name is Anastasia Shukina. I'm excited to guide you through today's session. So the focus of this webinar is to explore how private finance can play a transformative role in scaling nature-based solutions. With the pressing need to bridge significant funding gaps for environmental restoration, private finance mechanisms and innovative frameworks are more critical than ever. This session is designed to provide actionable insights for everyone, whether you're working on NbS projects, developing financing strategies, or simply seeking to learn more about sustainable investment opportunities. So let's dive in to how we can make private finance a powerful catalyst for positive change in our environment. Next slide, please. Looking at the agenda for today, I've structured this webinar to build your understanding progressively. We'll be moving from fundamental concepts to practical applications, all the while demonstrating through case studies. First, we'll establish a clear understanding of what private finance means in the context of nature-based solutions. This isn't just about understanding definitions. It's about recognizing how private capital can be strategically deployed to achieve environmental outcomes. Secondly, we'll explore the diverse types of private finance that's available. You'll have to think of this as your financial toolkit. Each instrument has its specific use case and optimal timing in a project's lifecycle. Understanding these differences is key to matching the right type of finance to your project's needs. Throughout this webinar, I would like you all to think about your own projects or initiatives. Consider which of these mechanisms might be most relevant to your work and what challenges you might need to address to access them. Next slide, please. So this slide presents a crucial context for our discussion today. We're looking at a significant financing gap for nature-based solutions that needs to be addressed. The numbers are stark. We need to almost triple annual nature-based investments from $200 billion to $542 billion by 2030. However, it's important to note that without a big turnaround on nature-negative finance flows, increased finance for NbS will have limited impact. What's particularly interesting is the projected shift in private sector involvement. Private investment has the potential to increase sevenfold, growing from 18% to 33% of total NbS finance by 2050. This represents an enormous opportunity for private finance innovation. To understand how we might achieve this growth, let's look at where private finance for nature stands today and what current trends tell us about the future directions. Next slide. Currently, private finance contributes $35 billion to nature-based solutions. So again, that's 18% of the global NbS finance. Let's look at where the money is flowing, because this reveals important market signals. First, biodiversity offsets and sustainable supply chains account for over half of private flows. This is significant because it shows where the market sees immediate value. Companies are increasingly recognizing that their supply chains need to be not just efficient, but environmentally sustainable. The fastest growth has been in two areas. In UNEP's 2023 State of Finance for Nature report, we see that from 2022 to 2023, philanthropy has surged 39%, largely driven by the global 30 by 30 initiative, which is a global conservation goal to protect 30% of the planet's lands and oceans by 2030. Blended finance deals have also grown in the same time span by 31%, demonstrating increasing sophistication in how we structure nature-based investments. So what does this mean for you? If you're developing projects these trends suggest that there's growing appetite for well-structured, nature-based investments. Buyers are increasingly interested in biodiversity credits alongside carbon, and blended finance approaches are gaining traction, opening new funding possibilities. A word of caution, though, these numbers also reveal gaps. Many nature-based solutions still struggle to attract private capital because they can't demonstrate clear revenue streams. To address these challenges and opportunities systematically, let's begin our deep dive into private finance mechanisms and how they support nature-based solutions. Next. As we begin segment 1, we'll start by building a clear understanding of private finance fundamentals, what it is, why it's essential, and its two critical roles: upfront capital needs and revenue generation. Next, we'll dive into the key players in the private finance space, including banks, impact investors, venture capital, and philanthropy. From there, we'll explore the various types of private finance instruments, ranging from philanthropic grants to commercial debt, each serving a specific purpose within the financing ecosystem. Finally, we'll introduce key frameworks within which the finance instruments interact to fund and scale nature-based solutions. Next, please. So I'd like to set the stage with a fundamental question. What exactly is private finance for nature-based solutions, and why does it matter? At its core, private finance involves investments from non-governmental entities. This includes everything from large institutional investors to individual impact investors. But what makes it particularly powerful in the context of nature-based solutions is its dual role. First, it provides the crucial upfront capital needed to launch projects, what we call asset-based finance. Think of a large-scale reforestation initiative. You need significant initial funding for seedlings, for labor, for infrastructure, before seeing any results. This is where private finance can bridge the gap between concept and implementation. Second, and equally important, is its role in generating ongoing revenue, or cash flow finance. This is crucial because environmental projects need to be sustainable in the long term. Imagine that same large-scale reforestation project. Through mechanisms like carbon credits or payments for ecosystem services, private finance helps create the financial flows that keep the project viable. As we move forward, keep this dual role in mind. It's fundamental to understanding how private finance can scale nature-based solutions. Next, please. Being familiar with the key players in the private finance ecosystem for NbS is key to know where to seek funding for your projects. Starting with philanthropic organizations and family offices. These are our crucial first movers. They provide the patient capital needed to prove new concepts and often take risks that others won't. The Rockefeller Foundation's work in blended finance for conservation demonstrates how philanthropy can catalyze broader investments in nature. Impact investors represent the next step in the financing journey. Unlike traditional investors, they're explicitly seeking both financial returns and environmental benefits. Take BlackRock's impact investing division. They're actively looking for projects that can demonstrate measurable environmental outcomes alongside financial returns. Venture capital firms serve as our innovation catalysts. They're willing to take bigger risks on new approaches and technologies. Consider how Breakthrough Energy Ventures is investing in regenerative agriculture technologies. They're betting on transformative solutions. Insurance companies are particularly interesting players. Their involvement is growing rapidly, and it's because they have a vested interest in reducing climate and environmental risks. Finally, banks and financial institutions represent the mainstream capital providers. They bring significant capital and established processes, but often need a proof of concept before engaging. Major banks like HSBC are increasingly creating dedicated nature-based investment products, but they typically look for scaled, proven projects. A practical insight: Successful projects often involve multiple players at different stages. You might start with philanthropic funding for proof of concept, bring in venture capital for scaling, and ultimately secure traditional bank financing for full deployment. Remember this key principle. Each player has different expectations for risk, return, and impact. Understanding these differences is essential for matching your project's needs with the right type of capital at the right time. Next slide, please. Now that we understand who the key players are, let's explore the specific instruments they use to finance nature-based solutions. These instruments form a spectrum that aligns with different stages of project development, risk levels, and financing needs. Looking at our project development curve on the left side, we can see how different instruments come into play at different stages. The journey typically starts with philanthropic grants during the high-risk incubation phase, when projects are testing new approaches and building proof of concept. As projects move into implementation, we see concessional finance and venture capital stepping in. While still dealing with relatively high risk, these instruments help protect, establish their operational models, and begin scaling. The scale-up phase brings in instruments like private equity and green bonds, which can deploy larger amounts of capital once projects have proven their models. Finally, as projects reach maturity, they can access institutional finance through public equity markets and commercial debt, representing full market integration. Let's examine each of these instruments in detail, starting with philanthropic grants. Next slide, please. So, philanthropic grants serve as the foundation for many nature-based solutions. These grants can take risks that other financing mechanisms cannot, precisely because they prioritize environmental and social impact over financial returns. As we saw earlier, philanthropy has shown remarkable growth, surging 39%, largely driven by the Global 30 by 30 initiative. This brings current philanthropic funding for nature-based solutions to around $1.34 billion in 2022. While this figure might appear modest compared to the total $35 billion in private finance, it's important to understand how these funds create significant leverage for larger investment. Philanthropic grants create value in several critical ways. First, they fund high-risk, early-stage projects before commercial viability. They support essential capacity building and technical assistance. They then provide proof of concept funding that attracts larger investments. And they test innovative approaches that could transform the field. For projects seeking philanthropic grants, several factors are crucial. There has to be a clear demonstration of environmental and social benefits. There has to be strong impact measurement and reporting systems. The pathway to scaling and attracting follow-on funding has to be clear, and there should be well-defined objectives and implementation plans. Philanthropic grants mark the beginning of a project's financing journey. Success means using this early-stage funding to build towards additional financing mechanisms and eventually financial sustainability. Next slide, please. The Buffelsdry project in South Africa shows us how philanthropic grants can spark transformative change. Starting in 2008, this project had a bold vision: transform a degraded landfill buffer zone into a thriving ecosystem while creating sustainable livelihoods for the local community. What makes this project special is its innovative treepreneurs approach. Instead of simply hiring contractors, the project trained local community members to become environmental entrepreneurs. They learned to collect seeds, grow seedlings, and plant trees, exchanging their work for credit notes they could use for food, education, and building materials. The impact has been remarkable. Over 600 local residents became treepreneurs, creating 455 jobs in the first 7 years alone. The environmental transformation is equally impressive. 1 million indigenous trees now stand where the degraded land once lay, and the area buzzes with biodiversity, home to 197 bird species. For your own projects, think about how you might follow Buffalo's Dry example. Start with strong community engagement. Measure both environmental and social impact. Create opportunities for sustainable livelihood. And always keep in mind the potential for scaling and replication. Remember, successful philanthropic projects like this do more than solve the immediate challenges. They create proof points that can attract larger scale funding and inspire a similar initiatives elsewhere. Next slide, please. So, when a project has proven its model but isn't quite ready for commercial investment, concessional finance steps in to bridge that gap. Think of it as financing that meets you halfway, offering longer terms and lower interest rates than commercial loans, but still expecting returns. What makes concessional finance particularly powerful is its patience. With terms stretching 15 to 20 years and interest rates that are 2 to 4% below market, it gives nature-based solutions the time they need to establish solid commercial track records. We see concessional finance working best in 3 ways. It helps de-risk projects for private investors. It supports promising projects that need favorable terms to scale. And it builds market confidence in nature-based business models. The funding can come from a diverse group of providers: development banks with their significant capital base, climate funds that are focused on environmental impacts, or government agencies that offer strategic support, even impact investors who are helping to bridge to commercial markets. For your project to attract concessional finance, you'll need a few things. Number 1, a proven model that's ready for scaling, clear impact metrics, strong governance, and potential for market returns. Let's look at a real example of how concessional finance can transform a project from promise to commercial success. Next slide, please. So, how concessional finance has been working in practice through the Tropical Landscape Finance Facility in Indonesia. The project works at significant scale, 45,000 hectares of degraded land, creating buffer zones between income-generating plantations and national parks. This design cleverly bridges conservation and commercial agriculture. 2 key elements made this possible. First, it's called strategic de-risking. The concessional element provided below market rates and longer repayment terms, making the investment attractive to commercial investors who would have otherwise stayed away. Second, smart structuring. By layering the different types of capital, concessional loans providing the foundation and private capital following, the project allowed different investors to participate at their preferred risk level. The results show what's possible with well-structured concessional finance. Critical ecosystems protected, sustainable livelihoods, proven model for scaling sustainable land use. Whether your project involves a few hundred or thousands of hectares, these same principles apply. Consider how you might use concessional finance to de-risk your project, create multiple revenue streams, and attract additional investors. The key is matching the financing structure to your project-specific needs and scale. Next slide, please. Let's now explore a financing mechanism that drives innovation in nature-based solutions: venture capital. Venture capital plays a unique role in the NbS ecosystem as the high-risk, high-reward engine of innovation. While concessional finance helps scale proven solutions, venture capital seeks breakthrough technologies and approaches that could fundamentally change how we approach environmental challenges. VC firms in the NbS space are focusing on transformative solutions. What makes venture capital particularly interesting is its appetite for risk. These investors look for potential 10 times returns or higher, and they're willing to accept that many investments won't succeed. This risk tolerance is crucial for driving innovation in the NbS space. Let's look at a practical example. A startup developing AI-powered forest monitoring technology might attract venture capital because it has the potential to revolutionize how we track and verify forest carbon credits. The technology is unproven, but the potential market is enormous. For those of you working on innovative or innovations in NbS projects, here's what venture capitalists typically look for. 1, a clear technological advantage or innovation, massive potential market, a strong team with relevant experience, clear environmental impact metrics, and of course, a path to scaling. Remember, venture capital isn't suitable for all NbS projects. It's specifically designed for high-growth, technology-driven solutions that could potentially transform the market. If you're working on a more traditional conservation project, other financing mechanisms might be more appropriate. Next slide, please. Now let's shift our focus to private equity. That's a very different type of financing from venture capital, but also somehow similar. And it's all different in particularly how it approaches NbS. Think of private equity as the next stage in a project's growth journey. While venture capital backs early innovations, private equity looks for established businesses that are ready to scale. We're talking about companies that already have revenue, market presence, and proven models. They just need capital and expertise to grow larger. A sustainable forestry company is a perfect example. Let's say they've been operating successfully for several years, their model works, they're generating revenue, but they need capital to acquire more land or upgrade operations. Private equity can provide not just the capital, often $50 million or more, but also the operational expertise to help scale the business. So what makes a project attractive to private equity? Strong existing assets, proven revenue streams, again, experienced management, clear growth opportunities, and market leadership potential. Here's what you need to have ready: a solid financial track record, clear growth strategy, strong management team, and a well-defined exit plan. Remember, private equity isn't suitable for early-stage projects or those without proven revenue models. It's for established businesses ready to take the next step in their growth journey. Next slide, please. Now let's explore how bonds, particularly green and sustainability-linked bonds, can channel private capital into nature-based solutions. Let's look at how this works in practice. Imagine a major food company that relies on cocoa for its products. They could issue 2 different types of bonds. With a green bond, they might raise $100 million specifically to help their farmers transition to sustainable agroforestry systems. The money can only be used for this purpose, and investors receive reports on how many hectares have been converted. That's the green bond. With a sustainability-linked bond, the same company might agree to pay investors less interest if they eliminate deforestation from their entire supply chain within 5 years. If they succeed, they save money. If they miss the target, they pay more. Here's what makes these bonds work for NbS. They can raise substantial funding. They provide long-term commitments. They show clear environmental results, and they attract large investors. While bonds are powerful tools, they work best for larger, established projects. If you're just starting out, you might want to explore other financing options first. Next slide, please. So, moving up the financing ladder, we're almost done, I promise. We reach public equity markets, where nature-based solutions gain access to retail and institutional investors through stock exchanges. This represents a significant milestone. NbS companies becoming mainstream investment opportunities. Think of it like this. When you buy shares in a public company, you own a small piece of that business. When nature-focused companies go public, it means everyday people can invest in environmental solutions through their retirement accounts or investment portfolios. Here's a simple example. When Beyond Meat went public, they weren't just selling veggie burgers. They were giving people a way to invest in sustainable food. Their success showed other environmentally focused companies that the public wants to invest in solutions that help nature. What makes going public powerful for environmental companies? One, they can raise money from many different investors. People can easily buy and sell shares. It also shows these companies can be good investments. And finally, it helps similar companies follow the same path. But going public isn't for every project. You'll need a business that's already successful with a clear plan for growth, proof that you're helping the environment, and strong leadership and systems. Remember, reaching the stock market is a big step that comes after other types of funding. Most projects start small and grow over time. Next slide, please. As we step into the realm of commercial debt and equity, we're entering the mainstream of private finance, the destination for many nature-based projects that have matured into commercially viable ventures. Let's imagine it this way. When a bank gives a loan, they're betting on steady repayments. When an investor buys equity, they're buying a stake in the success of a project. These two tools, debt and equity, offer different benefits but work together to help large-scale projects grow. Take the example of a sustainable forestry operation. A commercial loan might help them buy more land to plant trees, while an equity investor could help them expand into new markets and scale their impact. So why is commercial finance so significant? It taps into the largest pool of available capital. This is where billions flow every year into sustainability sectors. It helps projects scale. Mature ventures can use these funds to grow bigger and have a larger impact. But not every project is ready for commercial debt or equity. Here's what it takes: a track record of success and consistent cash flows, a scalable business model with clear profitability potential, tangible environmental impact metrics. The key players here are the traditional giants of finance: commercial banks, institutional investors, and corporate investors. These institutions focus on projects that have proven their viability and are ready to grow. With commercial debt and equity, we've completed the financing journey, from early philanthropic grants to mainstream private finance. Each step along this path builds on the last, providing the right support at the right time to ensure nature-based solutions thrive. Now, I'd like us to turn our attention to the frameworks that tie these financial instruments together and create a roadmap for project developers. Next slide, please. So now that we understand the full spectrum of financing mechanisms, from early stage grants to commercial finance, let's examine how these instruments work together within broader financing frameworks. Think of these frameworks as the architecture that allows different financing instruments to complement each other. Just as we saw how commercial debt and equity can work together to fund mature projects, effective frameworks help us combine multiple financing tools throughout a project's lifecycle. Three key frameworks have proven particularly effective for NbS projects: blended finance, which strategically combines public and private capital; impact investments that align returns with environmental outcomes; and market-based instruments, which is not strictly a financial framework, but more what we talked about before, creating revenue from ecosystem services for there to be sustainability in the long term. Each framework offers different ways to combine the financial mechanisms we've discussed. So let's examine how it works in practice. Next slide, please. So the first framework I'd like to highlight is blended finance, which plays a crucial role in overcoming barriers to private investments. Its purpose is clear. It uses public and philanthropic capital to reduce risk and attract private investors who might otherwise view the project as too risky. Think of blended finance as building a bridge. On one side, you have public or philanthropic capital, willing to take higher risk or accept lower return. On the other, you have private investors who need certain assurances before committing funds. Blended finance creates layers of protection, like first loss guarantees, concessional loans, or technical assistance that makes private investment feasible. For project developers, blended finance becomes relevant when you're working in challenging markets or regions where risks are high. Your business model is promising, but needs de-risking to attract private capital. Private investors are interested, but need risk reduction to move forward. Or you're seeking to establish a track record in a new context. Blended finance combines several tools to achieve its goals. We have philanthropic grants that fund technical assistance, capacity building, early stage support. We have concessional finance with below market rate loans. Again, remember what we talked about before, that reduce risks for private investors. And we have green bonds or sustainability linked bonds. These instruments can be layered onto the structure to raise additional capital while linking returns to project performance. Here's a simple example of how it works. Development banks might provide first loss capital, ensuring private investors face limited downside risk. Philanthropic funds could support technical assistance to improve project readiness. Private investors then step in with the majority of funding, leveraging the de-risked environment created by public and philanthropic capital. Blended finance isn't just about funding. It's about catalyzing private investments by strategically using public and philanthropic resources to unlock larger pools of capital. It's flexible and scalable, that has already shown success in high-risk regions and untested markets, making it a powerful tool in the financing landscape for nature-based solutions. Next slide, please. The And Green Fund provides an excellent illustration of blended finance in action, showing how public and private capital can work together to achieve both environmental and financial returns at scale. The fund operates at the intersection of agriculture, forestry, and conservation, addressing multiple challenges simultaneously, supporting the transition to sustainable agriculture, protecting existing forests, creating opportunities for smallhold farmers, and generating returns for investors. What makes And Green's model particularly effective is its structure. Concessional funding provides the risk buffer that makes projects investable. Private capital scales up successful interventions. Long-term financing matches the timeline needed for sustainable land use, and technical assistance ensures project success. The success factors offer important lessons for other blended finance initiatives. Strong partnerships ensure all stakeholders are aligned. Clear, measurable metrics demonstrate impact. Focus on scalability attracts commercial investors, and financial sustainability ensures long-term impact. For project developers, And Green demonstrates how blended finance can bridge the gap between conservation goals and commercial viability. The key is designing projects that can deliver both environmental and financial returns while managing risks effectively through the blended finance structure. Next slide, please. So for a more concrete example, let's look at the Lake Turkana wind power project in Kenya, which shows how blended finance can enable large-scale sustainable infrastructure. As Africa's largest wind farm, the project brought together multiple financing partners in a carefully structured arrangement. The European Investment Bank provided long-term financing. Private investors contributed equity and expertise. The Kenyan government offered crucial policy support, and development banks provided risk guarantees. This layered approach to risk sharing made possible what no single investor could achieve alone. The impact has been transformative. There has been a significant increase in Kenya's power generation capacity. There are local employment created and skill development opportunities, some stabilization in energy prices for consumers, and proof that large-scale. Several elements were crucial to the project's success. There was to be a clear allocation of risks between partners, strong government support and policy frameworks, well-structured revenue agreements, and significant development impact. The Lake Turkana project shows how blended finance can work across different sectors and scales. For project developers, the key lessons are consistent. Build strong partnerships across public and private sectors. Structure clear risk-sharing agreements. Secure reliable revenue streams, and maintain focus on measurable impact. Next slide, please. Impact investment, as the next framework that we'll be looking at, unlike blended finance, it doesn't necessarily involve public or philanthropic capital. Instead, it's purely private capital seeking both financial returns and measurable environmental impact. This framework becomes relevant when your project has a clear business model and can deliver competitive returns while achieving environmental goals. The key distinction is that impact investors aren't looking for risk reduction from public capital. They're willing to take market risks as long as the project can demonstrate both financial viability and environmental impact. Looking at the numbers, private impact investment flows to nature-based solutions reached $4.6 billion in 2022. For project developers, impact investment becomes relevant when you have a proven business model with clear revenue streams, your environmental impact is measurable and significant, you can offer market rate returns, you don't need risk reduction from public capital, and you have robust impact measurement systems. Impact investors use several financing tools to support projects, including venture capital, green bonds, sustainability-linked bonds, private equity, and carbon credits. These tools provide flexible mechanisms to channel capital into projects that align financial success with measurable environmental outcomes. An impact investment structure might look like this. Private investors provide capital directly. Returns are linked to both financial and environmental performance, and measurement systems track both metrics independently. The focus is on achieving market rate returns while delivering verified environmental benefits. Next slide, please. Let's dive into a real-world example of impact investment, the URAPI Fund, which supports sustainable agroforestry in Latin America. This fund demonstrates how private capital can drive both profitability and environmental restoration. The URAPI Fund targets $50 million in committed capital to transform coffee and cocoa landscapes, focusing on sustainable practices that benefit both farmers and the environment. The investment strategy is such. It invests in farmer cooperatives and SMEs, combining revenue from crop sales and carbon credits. Farmers receive technical assistance to adopt climate-smart agriculture, ensuring long-term sustainability. The key impacts are that over 13,000 smallholder farmers are supported, with a 30% increase in income. More than 54,000 hectares conserved, protecting critical ecosystems. The success factors here are that there's a strong local partnership that aligns with community needs. There are diversified revenue streams to reduce risk. There are clear environmental metrics to track progress, and there's a sustainable business model that balances profits with conservation. Lessons to learn from this. The URAPI Fund shows that impact investments can align financial returns with measurable environmental outcomes. Its success lies in integrating local partnerships, diversified income models, and a clear focus on both financial and environmental metrics. Next slide, please. This brings us to market-based instruments, which represents a fundamentally different approach from financing tools like grants, equity, or debt. Instead of providing upfront capital, they create revenue streams by monetizing environmental benefits. We talked about this in the very beginning of the webinar. The power of this framework lies in its ability to transform environmental benefits into tradable assets. Carbon markets are just one example, but market-based instruments can monetize various environmental benefits. Carbon sequestration is an example through carbon credits, but then we have watershed protection through water quality credits, biodiversity protection through biodiversity offsets, sustainable land use through certification schemes. For project developers, this framework becomes relevant when your project generates quantifiable environmental benefits. You can establish clear baselines and monitoring systems. There's an existing market for your environmental services, and you can achieve scale to make verification costs worthwhile. Unlike blended finance, which uses public capital to attract private investment, or impact investments, which relies on traditional business returns plus impact, market-based instruments create entirely new revenue streams. Your project's environmental benefits become its primary product. Next slide, please. The Cordillera Azul National Park in Peru exemplifies how market-based instruments can effectively finance conservation at scale. In this case, payment for ecosystem services through REDD+ has enabled the protection of 1.3 million hectares of rainforest while supporting local communities. The mechanics of this PES scheme are straightforward but effective. Communities receive direct payments for verifiable forest protection activities, creating an immediate economic incentive for conservation. This transforms traditional conservation approaches by making environmental protection financially viable for local residents. Looking at the project's implementation helps us understand why it's successful. Communities are active participants rather than passive recipients. The monitoring system provides clear verification of results. Carbon credits generate reliable, ongoing revenue, and biodiversity protection is integrated with carbon goals. For those considering similar projects, this example highlights how PES can bridge conservation goals with community needs. The key is creating a system where environmental protection becomes an economic opportunity rather than a constraint on development. Next slide, please. So now that we've seen how market-based instruments can transform conservation, I'd like us to move to the next segment in this webinar, innovative financing models. We'll explore 4 emerging innovations that are further reshaping how we finance nature-based solutions. These new approaches build on the foundations we've discussed, but introduce novel elements to address specific challenges in conservation finance. We have habitat banks and biodiversity credits, which represent an evolution beyond carbon markets. Blue bonds and blue finance can take the green bonds concept that we discussed earlier and adapt it specifically for marine and coastal ecosystems. We have debt for nature swaps, which offer an innovative approach to conservation finance at the sovereign level. And then the carbon market landscape, which is evolving rapidly with new standards from ICVCM and Article 6 agreements from Baku that strengthen market integrity. So let's examine each of these innovations in detail and understand how they might apply to your own projects. Next slide, please. So habitat banks and biodiversity credits represent one of the most promising innovations in conservation finance. Building on the success of carbon markets, these mechanisms expand our ability to monetize nature's value beyond just carbon sequestration. The concept is straightforward but powerful. Just as carbon markets create financial value for reducing emissions, biodiversity credits create value for protecting and restoring ecosystems. Developers who need to compensate for their environmental impacts can purchase credits from projects that have demonstrated improved biodiversity elsewhere. What makes this mechanism particularly interesting is its precision. Unlike carbon credits, which are fungible globally, biodiversity credits often need to be local or regional to ensure ecological relevance. The restoration or conservation actions must match the specific type of ecosystem being impacted. The market is still emerging, but several factors are driving growth. There's an increasing regulatory requirements for biodiversity compensation, growing corporate commitments to nature-positive outcomes, better metrics and verification systems, and raising awareness of biodiversity risks. For project developers, this creates new opportunities to monetize conservation and restoration work. Let's look at another innovative financing mechanism, blue bonds and blue finance. Next slide. So, blue finance represents a growing recognition that our oceans require dedicated financial solutions. Blue bonds and blue finance adapt familiar financial instruments to the unique challenges of marine conservation. While similar to green bonds in structure, these instruments are specifically designed to address ocean-based initiatives, from protecting coral reefs to supporting sustainable fisheries. The Global Fund for Coral Reefs provides an excellent example of blue finance in action. This innovative fund combines different financing approaches to address the complex challenges facing coral reef ecosystems. Grant funding supports initial conservation work. Impact investments scale successful interventions. Technical assistance ensures project success. And local communities remain central to conservation efforts. For project developers working in coastal and marine ecosystems, Blue Finance offers new opportunities to fund conservation work. The key is designing projects that deliver both environmental benefits and sustainable economic returns for local communities. Let's move to our next innovative conservation finance, the debt for nature swaps. So while Blue Finance creates new funding mechanisms for marine conservation, debt for nature swaps operates at an even larger scale by transforming sovereign debt into conservation funding. These innovative agreements and arrangements show how financial restructuring can create significant environmental benefits. The mechanics are elegant in the simplicity. Creditors agree to reduce or restructure a country's debt in exchange for guaranteed investments in conservation. This approach is particularly powerful because it addresses two challenges simultaneously: debt burden and environmental protection. The Belize example demonstrates the transformative potential of these swaps. In 2021, Belize reduced its debt by $189 million while committing to protect 30% of its ocean territory. This creates a win-win situation. The country reduces its debt burden, marine ecosystems gain long-term protection, and local communities benefited from sustainable resource management. What makes debt for nature swaps particularly interesting for conservation practitioners is their scale and permanence. For those working on large-scale conservation initiatives, understanding these swaps is crucial as they can create new opportunities for program funding and implementation. Next slide, please. Closing our segment on innovative financing models, carbon markets stand out as a powerful tool for driving large-scale impact while fostering inclusivity. Let's explore how recent innovations are reshaping carbon finance. I see there was also a question on Rabobank, and this is very interesting. Thank you for your question, because we will talk about this right here. So carbon markets have seen remarkable growth, reaching $851 billion in 2022, a 150% increase from 2021. Two recent developments are reshaping these markets: the ICVCM standards and Article 6 agreements in Baku, which establish stronger frameworks for both voluntary and compliance carbon markets. This evolution is particularly important because traditional carbon markets have typically excluded smaller players due to high costs and complex verification requirements. New platforms are beginning to change this landscape. So Rabobank's Acorn platform offers one example of this shift. By combining satellite technology with AI for verification and enabling small holders to participate through cooperative structures, it demonstrates how carbon markets can become more inclusive while maintaining integrity. The key innovation here isn't just about technology, it's about creating multiple revenue streams. Farmers can earn from both carbon credits and sustainable agriculture practices, making participation more financially viable. This evolution of carbon markets shows how these mechanisms can adapt to serve both environmental and social goals while maintaining high standards. For project developers, it demonstrates that carbon finance can work at various scales when the right structures are in place. Next slide, please. So, as we move into our final section, I know we're a little bit pressed for time, and I was hoping we could have some time for Q&A at the end. I'll try to rush through this as fast as I can. I want to leave you with three essential elements. We'll consolidate the key takeaways of today's webinar. This will help you apply these concepts to your own projects and contexts. Then we'll look at, I'll share with you some resources. Of course, this webinar will be shared with you, access to it will be shared with you right after. So in case you want to review the concepts, in case you'd like to check the case studies or look at the resources themselves, we'll allow you to that as well. And then hopefully we can still get to some Q&A. Let's see if I can get through this. Next slide, please. So to summarize the key points. Throughout today's session, we've explored how private finance can transform the funding landscape for nature-based solutions. Here are the essential takeaways that can guide your work in this space. First, private finance isn't just an option, it's essential. The need to reach $542 billion in annual NbS investments by 2030 from the current $200 billion means we must mobilize private capital at unprecedented scales. Your projects can be part of that transformation. Second, we've seen how different financing instruments serve different needs. From early-stage philanthropic grants to mature commercial finance, each tool has its place in the project development journey. Success often means using the right instruments at the right time. Third, frameworks like blended finance and market-based instruments provide the architecture for combining these tools effectively. They help us understand investments that work for both investors and project developers, creating sustainable funding models for conservation. Fourth, certain factors consistently drive success across all approaches. You must have seen the repetition in the slides. There should be clear, measurable impact metrics, strong governance structures, meaningful community engagement, and potential for scaling. Finally, our case studies from End Green Fund to the Belize debt swap show that these aren't just theoretical concepts. These approaches are already funding transformative projects worldwide. As you return to your own work, consider how these elements might combine to support your specific projects and objectives. The key is matching the right financing approaches to your project stage, scale, and needs. Next slide, please. So as we conclude today's session, I'd like to leave you with practical steps for moving forward with financing your nature-based solutions. First, explore the financing opportunities we've discussed. Take time to assess which instrument best matches your project stage and needs. Consider whether blended finance might help de-risk your project or if market-based instruments could create sustainable revenue streams. Second, stakeholder engagement is crucial. The examples you've seen today, from development banks to impact investors, show how different partners can strengthen your project. Consider which partnerships could help you scale your impact. And finally, remember that success in attracting finance relies heavily on strong metrics and governance. Clear, measured outcomes and robust governance structures will make your projects more attractive to investors. So thank you for your attention today. I was trying to get through this as quickly as I can. I'm happy to take any of your questions about specific financing mechanisms or how to apply these concepts. And if we do go over time, I will be happy to answer the questions. You can send them in the chat box. I can answer them and then send them to you in the end as part of the final package. So if you have any questions, please feel free. Q&A. Just a second. I'm trying to pull up your questions. I'm not sure where to put them. If you do have them, just do send them in. And I can always, if there are no questions, then I think, yep, of course, the presentation and recording will definitely be shared. And if anything else comes up, because I know it's a lot, there's been a lot of information and quite dense. So I understand that if you need a little bit of time to focus the right questions, feel free to email me and then I'll respond to you whenever, right after. Will there be follow-up sessions? This is the last, I believe, of the Restoration Initiative webinar series, at least for this year. In case any other webinars come up, I will definitely send you an email. I have all your emails that are recorded, so we will definitely alert you ahead of time. And do keep an eye on LinkedIn, on our socials, so you can always access that. Thank you. Thank you for joining. All right. Thank you so much. I'm glad to hear that. Thank you, everyone. Well, in that case, we will be closing this webinar, and I wish you all a lovely day and a lovely rest of your afternoon wherever you are. Perfect. Thank you. Have a good day, everyone. Bye-bye.